Hi, my name is Christine Giordano from Markets Group, and I'm here with Tim Barrett. He's the CIO of Texas Tech, but he's also one of the few CIOs who has worked at both a public pension, a corporate pension, and then became a university CIO. So he has this unique perspective, and he's about to go into it. But another thing about Tim is he's known as a strategist intellectually. So we'll talk about what's happening with the economy, as well as some of the moves that he made throughout his career to improve the funds that he's worked at. We're about to honor Tim with a Hall of Fame award during our investors conference in Austin, October 8th and 9th. We'll honor Tim October 9th. So, allocators, come on in. Tim, welcome. How are you?
Thank you. I'm great. Thank you.
Thank you so much for making time for this interview. Appreciate it. I'm going to just kind of jump right in. As
Okay.
one of the few CIOs who's been, at a public pension, a corporate pension, and an endowment, what, in your opinion, is key to survival in each place?
Right. That's a great question. I mean, key to survival, obviously, for any CIO is actually performance when you boil it all down, right? If you don't perform, you're not going to stick around in any of those environments. But as important, I think, is performance is how you communicate and how you connect with people. So whether you're talking about a public pension board that would have lay people on it, say from fire and police on your board, or general employees of some government entity, to a corporate board that's with professional treasurers and CFOs on your board, to endowments that typically have investment professionals on their boards. There's quite a wide disparity of talent and understanding in those groups, right? So your ability to communicate with the fire and police guys about what you're doing in the portfolio and very complex investments is critical, because you have to gain their support and their trust. The same can be said at the endowment level, but frankly, that's easier because you have more investment professionals on those boards, and it's easier to communicate because that comes natural to a CIO, is to talk about the more complex things. But the real skill is to be able to boil down that complexity into smaller bite sizes so that lay people can understand it. And without that skill, I think it's very difficult to survive as a CIO in any of those environments.
And Tim, I mean, you came from a family of farmers, and
Yes.
then went into finance. So did that come innately to you, like when you discuss your day over the dinner table with your folks?
Yeah.
How did you develop that skill in breaking things down?
I do not think it really came from my youth, right? And how I was brought up. I wish I could say that I always innately had that skill. I think that's something that you learn over time by trial and error, right? So I became a CIO pretty young at SB Sarah after really 3 years in the industry. And you had to pretty quickly adapt and learn to speak and be quick on your feet to be in that role. And I think I just learned that over time.
SB Sarah meaning San
San-
Bernardino, right?
Yeah, San Bernardino County Employees Retirement Association. Yes,
And you were there from 96 to 2010?
that's correct.
Great. And you, during that time, you were able to take that fund into the modern age. You implemented derivatives, private equity, full autonomy for the staff.
Yeah.
Can you kind of get into that?
Yeah, I think when you think about that plan, and the way it was governed, we had a lot of support, right? So we had a lot of support from the board to make changes over time. And it was really a discussion with the consultant and Alan Martin, who was a great mentor of mine, that we talked about how do you get to a place with boards where you can implement things quicker and faster. And we wanted to take advantage of co-investments. We wanted to take advantage of trading derivatives on the portfolio. So it's really a long process of having those discussions and getting Alan's support to talk to the board to allow us the authority to select managers to do co-investments and also build out that portable alpha program. And I would say that happened over multiple years, right? It wasn't this, a lot of people think that I just walked in and I got this autonomy and they said, oh yeah, take it, Tim. That's not how things work, right? You have to earn that over time, and you slowly changed it. So when you think about the board, they used to select the managers, they'd interview them and they'd select them. Then we got to a point where we got agreement with the board where we're going to bring you a manager that we think is best fit. And it was automatic that they would select that manager, right? So that's pseudo autonomy, right? Because they're allowing you to bring the manager and they're selecting it almost no matter what, unless there's some, veto on the side because they don't like the asset class or whatever. And then you fast forward that a couple of years, and then we just started updating the managers that we hired to them, right? So that kind of happened over a few year period and that autonomy. And it also impacted performance. Our performance started improving dramatically so that they were very happy with giving us that autonomy, right? So that's kind of how that worked.
Okay. And other than kind of suggesting good managers, it was the returns that made your case for autonomy, correct?
I think it did, right? When you looked at the alpha that we created in our portable alpha program, and we also implemented what we called a smart beta. It was a tactical asset allocation overlay where we traded derivatives to move the portfolio around based on fundamental factors. We did that with a group called M Cubed, who had the software and technology to do it. That wildly outperformed the market. So that tactical allocation added substantial value, and I think the board recognized that we were adding a lot of value and gave them comfort to continue with the autonomy that we had.
Are you still using that strategy today?
We aren't using the tactical allocation software strategy today, but we do tactically allocate. But it's more on a subjective basis.
How have you changed it?
Well, before it was rules driven, right? At SB Sarah, so that you built models and you ran based on those models. What we've done here is when we look at the market and we see big dislocations or changes, regime shifts, then we'll make shifts in the market. And I think a perfect example would be if you look back about 18 months ago or so, we made a big push into quality, right? That's a massive tactical shift away from our benchmark. It's a factor bet. That factor bet, I think, has outperformed like 1,400 basis points over our index over that period. So it's really had substantial value. We'll probably keep that on for a while, and we can talk about where we think markets are going, but we'll probably maintain that position for a while going forward. But that's more indicative of what we do now. And I'd say the other piece that we do now is most of the portfolio in Texas Tech is alternatives. So we don't have to take quite as many tilts and factor bets and things like that I would have years ago, because there's more managers and more differentiated strategies that we can select from. So in credit, for instance, like we own a little bit of high yield. We don't own anything in the bar cap, really. It's almost all credit hedge funds, and they're very direct, niche strategies that we want to target that we think are all weather, right? So these guys themselves at these hedge funds will tactically trade those credit markets where we don't have to internally and provide that consistent return that we're targeting. So it's really become a little bit more strategy focused than tactical.
Mm-hmm. Yeah, maybe we should just continue with the career story in a little bit, but kind of go right into, the changes that you've been making recently now, since you're on it.
All right.
Yeah.
Well, the portfolio, just to level set, is based on a global 60-40. So our benchmark's a global 60-40 plus 100, meaning 60% in the all country world index, 40% in the bar cap. The way we structure it roughly is of that 60, roughly 40% is public equities, roughly 20% is private equity oriented things. So it could be venture cap, buyouts, real assets, oil and gas. And then on the stable value side, that 40% is kind of broken up between, let's call it more absolute return type hedge funds that's also used in portable alpha, and then more credit oriented hedge funds and private credit, roughly evenly split 20% each. So when we think about like the way we think about the portfolio is how can we build one of those substructures that dramatically outperforms that benchmark? So that's always our starting point. From there, we look for opportunities, right? And it could be little niche opportunities that we find. For instance, one of the things that we're looking at recently is nano sand for batteries. So there's a company that we're digging in very deeply with that takes rock, crushes it, runs it through a process, and this nano sand has high conductivity compared to graphene and can dramatically improve battery, both the storage and the speed with which it can take a charge. So that's the example of something really interesting that everybody in the office honestly is geeking out a little bit on. I don't know if we'll end up doing it, but it's an example of like some of the things that we look at. When you think about the portfolio and tactical, we still like the quality that I mentioned before. And in fact, we were about 50-50 quality versus equity weights in our equity book. And more recently, we put a hedge on to hedge out the semiconductor exposure in the quality benchmark back to equity weights to take risk off the table, because we've beaten the index by so much that we wanted to like harvest some of those gains. So we shorted out the differential. Then a few weeks ago, you saw where the semiconductors really got hit, and our shorts, paid for themselves. I then turned around that same day, and then we went long another 25% of quality to pick up the semis, not shorting out, to pick up the semis when they bounce back. So we picked up that trade kind of full circle. Wow. And as everybody was getting pessimistic about semiconductors and the economy, because that's what was going on when they traded off, it also had a major impact on rates. And you saw the rate trade really change a lot. So we sold out of a bunch of 2-year paper, bought 1-month paper, and captured that change in yields over that same period. So I would say that, those opportunities don't come around often. But when they do, we try to capture some of that if we can. Sometimes they happen so quickly that you can't catch it. And sometimes there's a lot of luck involved. So when we put the short on that semis, I had no idea that it was going to trade off the next week, right? We just had looked at the semis and they were up 78% last year. And we were like, I don't think it'll do it again. We should lock in our gains. So sometimes just the simple decision saying, hey, I'm going to take risk off the table works in your favor.
Wow. Are you seeing anything ahead in the equity or the rates market?
Yeah, we still think quality is really interesting through this part of the cycle. Mm-hmm. If you think about quality, they have really strong balance sheets and really strong fundamentals, right? So if you think things could get tough in the near future, like you'd rather be in quality than growth, right? Just straight growth. So I think it does well if we start to stumble a little bit and go to recession and the Fed doesn't get the rate regime right by lowering rates. Where you'll see the regime shift, in my opinion, would be if you just fast forward and say, hey, they're going to get the lowering of rates perfect and they're going to glide us into growth cycle again. If you glide into a growth cycle, quality's wrong, right? What's right then? Small cap and growth and cyclicals and those kind of things, that's where you need to shift. So really, it's a lot about reading those tea leaves, like what's going to move the economy to that growth phase?
Yeah.
And how are we going to get there? If you see those tea leaves starting to turn over, we're getting there, then you need to start moving to small cap, cyclicals, all those things.
Okay, so what are you watching for as far as that shift?
Right. We're watching for what we think the normalized inflation rate is over time and where rates are, right? We don't want to see a big differential in those. We want to see those come together. Mm-hmm. And then I think the other things you want to watch is just the consumer, right? How are things going with the consumer? Are they holding up well? What are credit card delinquencies? You're looking for those tea leaves that say, hey, certain segments of the population are getting in trouble. The low income earners are already kind of starting to get in trouble. Where's the middle class at? Where's the upper class at? So you want to kind of look at what those defaults are and see if the dominoes start falling, you want to start staying in quality, be a little more defensive. If things start turning and those things start to ebb a little bit and they're not getting as bad, then I think you're starting to get closer to the cyclical trade.
Love it. Thank you. I'm going to return back to your career because it's kind of exciting in its own way. You were also at Eastman Kodak from 2010 to 2013. From there, you managed 77 global plans, 4 to 5 of them directly, all different boards. How did you do that? And what was key to doing it right?
Well, the easiest way to explain how I did that is I traveled a lot. So you're on a plane quite frequently, going to those board meetings overseas. So it keeps you quite busy. I think the biggest accomplishment there was consolidating the plans. So when I got there, those plans were the ones that we managed were all different manager lineups and different asset allocations because they had different boards. Well, that makes sense if you have a really big staff, but Kodak did not. It was me and the gentleman I hired was Tom Muha, who was the previous CIO at Kodak, and a lady named Mary O'Reilly, who now is CIO at Excelis. The three of us ran all of that. So you're talking 3 people. It's very, very difficult to have that many managers and do a good job covering.
Wow.
So the very first order of business was, how can I take this US plan, restructure it so it's tighter with less managers, and then use those same managers in the global plans and convince different boards to do this. That took several months, but we got everybody on board with a plan. I will tell you the difference between like a corporate and say a public fund or someone else is, even though there's all these different corporate boards that are in different countries, the head of global at Eastman Kodak, the treasurer, was on every one of those boards, and he was the head. So when you're going to convince, you're really convincing him that, hey, here's the game plan, here's how we're going to do it. And he has a lot of influence with all these subsidiaries, right, to do that. So part of it was getting on board with him and getting all these boards to agree that we're going to go with this new framework. We're going to consolidate managers off the U.S. plan, so that everybody's overlapped and it's a similar program across the whole entity. We were able to do that. I'd say the other thing that was really important at Kodak is that endowment guys and pension funds don't think as much about is liability hedging. When I got to Kodak, they were over 100% funded, but they were not very hedged in their liability hedging. And of course, it was around bankruptcy time that I joined, right? So it wasn't like they could afford to have a big hit. Yeah. So the message from the treasurer was, don't lose money versus our liability stream. Well, what are you going to do? Well, the very first thing you do as a CIO, say, wait a minute, if I can't lose any money versus liability stream, what am I going to do? You're going to invest your way out of that? You can't. You have to hedge your way out of that. So we immediately went in and moved the liability hedging from like the 70s to like 95% hedged, almost instantaneously. That removed that risk of underperforming your liability hedge, which in corporate speaks means you got to pay money.
And that pension plan eventually became more than the valuation of the entire company, right?
I can't take any credit for the valuation of the company. I wasn't involved that side, but I believe the pension fund was worth more than the company. Yeah. One of the fascinating things that happened in the European plan, which had never happened in European history before, at least in UK history, was one of our companies was in the UK. It was a paper company, and I forget, there was another subsidiary of that as well. But the parent company had guaranteed the liabilities of those entities, which was probably not a good idea. So in bankruptcy, those companies made an offer that if Kodak forgave the liability, and then they negotiated buying the companies themselves, and that worked out phenomenal because Kodak was never going to pay the liabilities of those companies. So they were able to negotiate buying themselves disassociating from the pension and then reattaching afterwards, which had never been done in history. The bottom line is what happened is you went from 30 cents on the dollar that each pensioner was going to get through the bankruptcy process to making those legal moves, and it was at 75% almost instantaneously. So you improved pensioners' lives dramatically by that move, and that's never been done in history.
Wow. Congratulations.
Yeah, it was a really interesting, and there's professional trustees over there that are really phenomenal, and I can't take credit for the idea. It was a professional trustee, but I got to watch that whole process and be a part of it. It's very interesting.
Hmm. Any key takeaways there as far as?
Well, I think the key takeaways there is you never give up the fight, right? These companies were down on their back and they were going to go through the bankruptcy process. And, it's in the dark of the night. It's when things are really going bad, you learn what you're made of, right? You have to get up and fight. And these guys did. Wow. And I think it's just never give up. And, I think that takes me directly into like one of the things that we've talked about in the past, which is kind of like what was one of the scary moments. And this is kind of to me, it's kind of a corollary of the Kodak deal, right? And this happened at SB Sarah, and that's back when Don Pierce is the current CIO there, and James Perry was there, and Brian Long and myself. And this was in 2008, so it was in the depths of the crisis. We had about $1 billion portfolio of levered loans. Okay. And we had these in separate accounts, and we used what's called TRS lines, total return swaps, right, to get leverage to buy more loans, right? And it was about 3 times leverage. And, we were making great returns until 2008 happened, right? And if you remember what happened to senior loans almost always trade around par, 90 to 100, that range. Well, in the GFC, everything went crazy. And senior loans traded down into the 60s.
Oh, my God.
Well, if you have TRS lines with banks for leverage and their collateral goes from, hey, it looks really rosy at 90 to 100 down to 60, I can tell you what they did. They pulled the lines, right? So you're sitting on this leverage. All your loans have tanked. You're 3 times levered and you got to sell out. You're going to be washed out, right? And I will tell you, this is the one time when I say it's the scariest time when I thought, Tim, car sales, that's a good second career for you, because that's where I thought I was going to be. I'm serious. I was like, I better bone up on what the Cadillacs are today. But it also is a correlate back to what I said before, right? Where you have to dig in when things are bad. You got to look for solutions, and you don't quit looking for solutions till there's no hope, right? Like you got to dig. And my team and I started calling all of our credit managers, right? And we eventually found 2 credit managers that had open credit lines.
Wow.
And we negotiate starting new hedge funds, basically, or new private levered funds with each one of these independent entities, utilizing their credit lines. So we used our loans, negotiate selling our loans directly to them at a separate account, re-levered up and bought more at a higher leverage rate. And I believe the rate on those facilities at the time were like LIBOR plus 20 basis points. So basically it was free leverage. So then we re-levered at 60 cents on the dollar at a higher level than we sold out at. And we ended up making the most amount of money ever made in SB Sarah history on any trade. And that, I'm talking about round trip from the beginning to the end all the way back. So taking into account the loss and the gain, that was the largest winning trade. We made billions of dollars off that trade. So when I say never give up, don't give up. There's always a solution. And my team was a massive part of that, right? James Perry and Don Pierce and Brian, everybody was involved. Because everybody thought we were going to be working at the car dealer next week. So
going from the scariest moment of your career to the most lucrative.
Yes.
In that time. Wow. And okay, so set the scene for me as if it's a movie. Were you calling these creditors in the middle of the night? You're just kind of rolling through what then was the Rolodex, trying to, find whoever it was that was available? How many did you call?
We only called our managers. It just so happened that two of our marriage managers, and it was Aries and Stone Tower. Stone Tower was Mike Levitt's firm, was eventually bought by Apollo, I believe. Each one of those already managed money for us. And it just so happened that they had those credit lines. Like if they didn't have those credit lines, I'm sure we would have kept calling more managers. We'd probably called Blackstone and everybody else.
Yeah.
But it just so happened that they had it. I would say that whole process, we got an extension on our TRSs for them to hold us off. I think they gave us like I believe it was a 45-day notice to close. So we did all of this stuff in like 45 days, like renegotiated with the other two firms, renegotiated on a loan by loan basis on what the pricing would be, cutting it over to them.
Yeah.
And, I don't know that we got that great of a deal on the pricing because I think, it was very clear that we were in distress. So the managers, they got a pretty good deal. But by partnering with them and using their leverage line, we were able to still come out on top on the trade. But yeah, very stressful time period.
Yeah. Yeah. And so, okay, that was the great financial crisis.
Yep.
Senior secured debt obviously wasn't as secure as one would have thought. What are you careful of now? I mean, senior secured debt is right. If I'm right, it's supposed to be the first thing that's paid off, right? As far as debt is concerned. So correct. How did it go down to 60 on the dollar?
It's the whole market went down that level. I mean, people were pricing in what I would call like an Armageddon view, like nothing was going to last. It's also, it's the reason what you said is the exact reason why we had confidence to back it and re-lever it up. Because two things were going to happen, right? Either every single company that is going under and no one's going to work and we're all going back to caveman, or these things are going to rebound at some point. How fast they rebound, I'm not real sure. But if everything else goes away, we own all these companies, right? We're the senior debt. So that's the best place to invest for a sure return that's going to come back, right? You're not sure if all the equity is going to come back. You don't know if the mezz will come back, if they go through bankruptcy. But the senior debt's it's going to survive.
Any senior debt that you decided to dump? Any sectors?
Not at that time. We transferred every single loan, regardless of whether the manager liked it, over to the new managers in their new funds. And it was up to them to underwrite the credit and trade in or out of what they saw as best.
What a story.
Yeah, it's pretty awesome.
In a few minutes, let's get back into the Irish whiskey story. That's another fun one. Oh, yeah. But okay, so now you're at Texas Tech as Associate Vice Chancellor and CIO. You've been there since 2013. You've gotten autonomy for your staff, portable alpha you've used, derivatives. You've invested in venture capital, private credit, hedge funds. This is all new stuff from when you started there, correct?
Yeah, I would say that Tech had a decent portfolio. They had a little bit of private equity. They didn't use hedge funds as prolifically as we do in the credit space. They're more traditional hedge fund strategies in the portfolio at that time. So I would say it's morphed a lot. The portable alpha is probably the biggest one because that uses a lot of absolute return hedge funds as well as derivatives on top of it. And the way we structure it it's really quite different. Traditional portable alpha, which a lot of people probably think is complex, but basically you're just separating beta and alpha. Beta being the market return, right? So for us, that's the ACWI. I mentioned like 60% is benchmarked against ACWI. So our baseline is to buy an ACWI swap so we know we get that return, right? Then we invest, because that doesn't cost money. We take the money and we used to invest it in hedge funds, about 80% of that money and 20% in cash. That works pretty good until there's a really big market drawdown because the margin call on the equity swap is going to take all that 20% away if the market's down 20%. So you need to have other forms of liquidity if you're going to run that type of levered program. is what we did is we turned around and said, yes, that's interesting, but let's turn some of the hedge funds into swaps themselves. And now we have a beta swap on top of a hedge fund swap and all the cash behind it. So what that does is move you, before when I mentioned it, you could have a 20% drawdown and recover. This new structure, I could have a 50% drawdown and still not be taken out of the trade. So it's what we did is we create a lot of cash flow behind both of those swaps to protect against margin calls. Mm-hmm. And we would never get to 50 because we're pretty active trading the beta anyway. So if we start seeing the market and the technicals all turn over, we're going to reduce exposure pretty rapidly. So we're not worried about hitting the max drawdowns really ever.
What else are you doing that's contrarian?
Contrarian. I don't know that there is a ton of really contrarian stuff. I mean, the areas that we like right now are honestly a little more traditional. Like, I would say we're at the bottom of the real estate cycle. Like from my perspective, people should be stepping on the gas with real estate. Now, I'm not necessarily saying office because I know everybody goes to office and said, oh, the world's still a mess with office. Yeah, it is. It is still a mess with office. And apartments in certain places don't look good, right? Nashville's completely overbuilt. They have so many apartments, like I wouldn't touch apartments there. Austin is a little overbuilt, but there's areas you can find now to get into real estate that I think is really attractive, especially with the rate environment getting ready to come down. So you'll capitalize on that. I'd say the other place where everybody's run away from is oil and gas.
Wait. I want to go back to what areas you're finding attractive in real estate.
Real estate, single family home stuff is still really attractive to me. We're way underbuilt on single family homes. Certain workforce housing areas are really interesting right now. I still like self-storage. I think it's an interesting asset class to have in your portfolio. And internationally, real estate also looks good over in Europe. So we have a lot of exposure through Blackstone and other managers and get to see the deals that they're doing. It's quite attractive. I'd say the second strategy underneath that, because we're talking about directly going out and building or buying real estate, the other place is the distress cycle. Like there's going to be a lot of hung loans on real estate, and there already is. And those guys are running into walls. So they're going to need refinanced out. So you're going to be able to go in and pick up assets much cheaper, I think, on the distress side as well. So I would look for with people that have really good workout experience that can attack that market.
Nice. Anything you would avoid other than, let's say, office that you just mentioned?
I think location is the ultimate thing in real estate. There's certain geographies like I don't really want to touch. Like I'm not very interested in New York City, to be honest. I'm not very interested in Nashville because I think it's overbuilt. So there's certain areas like that. Like we know a little bit about that and we try to stay on tune in that as a staff, like, where should we be going? We learn most of that from our managers, right? Our real estate guys, because we're not doing real estate direct. So we hire the manager, like we'll talk to them about where the most attractive places are. We try to triangulate between the several managers that we talk to on a regular basis to see where there's overlap there. And that's really how we ascertain our strategy in real estate.
Mm-hmm. And in Europe, what countries?
We like the UK. We still like Germany. We have German assets. Even Spain is better. And even some of the laws in Spain are better, right? Bankruptcy law used to be really terrible in Spain. And they've dramatically improved that over the last couple of years. And we're finding not only corporate, going into corporate investing interesting there, but as well as real estate too. So doing loans, doing equity, like you're better protected in Spain than you have been in the last 50 years.
Makes sense. And we're starting to talk about oil and gas.
Oh, that's right. Oil and gas is something we're looking at for this year, actually. We used to have, when I came here, we probably had almost 15, 18% in oil and gas in the portfolio. It was a massive oil and gas portfolio. We've run that down over time because I find oil and gas investing is really hard, right? It's a very cyclical industry. If you catch it right, you make a lot of money, but funds are 10 years long. So I almost guarantee you're going to take a little bit of a ride during the fund life, right? But we think now, especially because everybody's really focused on green energy, electric cars, and that, and they probably should be, right? I mean, that's good for the environment. But oil and gas is not going away. And we think the ESG movement has really pushed a lot of the capital out of that market, making opportunities much more attractive and a lot more opportunities for the managers that are left that are in that space. So we like midstream, we like downstream, we like all of it right now.
Mm. Being in Texas, do you have a certain viewpoint as far as what what looks most promising? There's a lot of talk of the infrastructure.
Yeah, I think some of the infrastructure is interesting. Like for instance, we're in a greenfield project. It's for a LNG project, and that one's getting contracts. We think that's a really interesting spot to be. So like think of Sheneri Energy, right? That Cheniere's like made a ton of money in that space. Ours is greenfield. They've signed a few contracts. I think they'll start to go live on production soon. That's been a great equity trade for us. We like the core of the basins, right? So Permian Basin, Eagle Ford. If you get in the core of those basins, I think that you'll make money, and the return on cash is great right now.
Okay. Now, is it true that you made 109% returns in 9 months on Irish whiskey?
That's actually a true story. It's one of my favorite. It came from one of our managers in Fort Worth, and it was a co-investment deal. And to tell you the truth, I kind of almost fell out of my chair when I read it. I couldn't believe that, like, it was a credit manager that was pitching us like a deal that they'd run across on Irish whiskey. And I was like, Irish whiskey? Like, I don't know that much about it. So they got me up to speed. Like, so we read their decks and went through and had discussions with them and everybody. And it was really a distressed trade. So the person that had the whiskey needed out of it. And then you just replace it to back to a branding company that makes Irish whiskey. So the whole round trip trade only lasted 9 months, which was really short. But to make 109% in 9 months, we're quite proud. I will admit it was on not a large amount base of capital, but still was super exciting. And that really led us into doing other deals. Like we did another deal with a firm in New York called Metropolitan, where Metropolitan built like an AB note structure based on bourbon. So they're a credit manager. So the B was the branding company. The equity was the branding company, and we were the debt structure in that. That strategy we ran for I think it ran for about 7 years ish. That generated like 40% IRRs over the 7-year period, and that was meaningful money. That was a regular full size allocation for us. So that was a phenomenal strategy as well. So we're not too shy about doing things that are a little bit off the beaten path. We think there's a lot of value in that. Like I like reinsurance a lot right now. I think there's opportunity there. So we'll look at these things, and if we find opportunity, we will jump on them.
Yeah. So you mentioned the reinsurance.
Mm-hmm.
What else are you looking at now that's fascinating to you, and why reinsurance? What's up in that market?
Yeah, I just think that if you get with a really good reinsurer, like you just think of everybody's buying insurance for cybersecurity, right? So that's a whole mono line of reinsurance is cybersecurity itself for corporations. That's pretty lucrative. People don't get hit with cyber crimes every day. If you have a big diversified mix, it's a pretty nice revenue generating business. But when you mix that in with perils on casualty and different things, you get a completely uncorrelated portfolio to the stock market, right? Which in the end is the biggest driver of risk and return in the whole portfolio for any of us, right? Whether you're a pension endowment or us. Where that stock market goes drives your whole portfolio. So it's what you're looking for with whether it's Irish whiskey or bourbon trade or reinsurance, is you're looking for less correlation, right? I would say precious metals is another one, right? That you could probably go into that would be a little less correlated, right? But reinsurance portfolio in that vein, I think you can get to that mid-teens return and have very little to low correlation.
Mm-hmm. And back to the whiskey and the bourbon, they say those are recession proof. Right. People need them either way. Is that true?
I think needs an interesting way to phrase it. I'm not sure people need it. I do think that it's probably not on the same economic cycle as most assets, right? When things get really bad, people do tend to drink, which is probably not good, but they do. And then and what the bourbon guys will tell you is, yeah. And also when times are good, everybody celebrates. So both times they're drinking still, right? I think the interesting thing about the bourbon market is just that it's going more international now, right? Bourbon's, the Japanese like bourbon, right? They're trying to push into China now. Europeans still buy bourbon. Australians buy bourbon. Even in India, they export bourbon to India. So those markets, if the current bourbon production was to push out as much as I think the demand will happen internationally, there wouldn't be enough bourbon. So I think it's a market that has plenty of growth potential in it and demand that will keep it going for quite some time. I do think the returns you get on barrels, say 2 years ago, is way too high, and we've seen that come down over the last couple of years. But honestly, if you can make 15 to 20% returns with very little risk by holding bourbon and then sell it to an offtake agreement, it's a pretty interesting uncorrelated trade.
A lot of sense. People are buzzing about the grid. What are your thoughts on the grid investments?
We haven't really found a way to implement grid investments per se directly. Like we don't have a specialty fund that's what they focus on. There's a massive problem with the grid, right? And I think everybody in America knows that. I don't know what the solution is, and I don't know that anybody's found it. So your first impact on the grid is where are all the data centers going, right? Because data centers suck up tons of energy, right? So you can't run those on lines just anywhere. So now they're starting to put data centers right next to power plants. And like, I know one investment manager that's literally building add-on power plants next to the power plant just to run data centers. And that's a big push now. I think that, anybody that's in the data center business probably knows that. And it's an interesting strategy, but there's not that many spots you can do that. So everybody will rush out and do that. That'll fill up very fast. They're going to have to come out with a way to transmit and store energy in a better, more efficient manner. So to me, it has to almost come from some kind of battery type technology, or you got to start building small scale nuclear reactor plants, right? Think of the same ones that are used in nuclear submarines. You never hear about them having a problem, right? It's because they don't. But they're really small scale nuclear plants that you could then plop down near cities or near data centers and cities to more efficiently fuel those areas. So I think there needs to be radical transformation of not only our energy production, but the grid itself for all those things.
Brings into the whole equation of nuclear waste and the half-life of that. And is there a way to actually dispose of it these days?
Yeah, I don't think that there's a way to completely dispose of nuclear waste perfectly from my perspective. But I think the small scale reactors get a lot closer with less than the old scale, like 3 Mile Island type nuclear reactors of the old days. So they have gotten better at it. There is no perfect answer to energy, right? Like it's not windy all the time. It's not sunny all the time. Petrochemicals, petro pushes off chemicals. Nuclear has waste. So I think it's called diversification that we're going to have to hope for in that area.
Sure. Or yeah, and then there are the rare earths and
right.
All of the debate. Okay, let's move on to something more positive.
All right.
Can you tell me about the influence of some of your mentors on your career?
Oh, yeah, I've had I think that's probably the best part of this industry. Is one of the best parts is the people that you get to interact with are incredible. Um, from your staff to people that mentor and help train you, right? So if I were to go way back, like there was a guy at a firm called First Quadrant named Rick Robertson, phenomenal guy back in the day, and he took it upon himself. I mean, obviously, he was trying to sell me a product at the time, but he took it upon himself and went way beyond that and started really teaching me about derivatives. Um, yes, I was a CFA, so I understood them, but not at a level Rick did. Rick understood all the Greeks and trading options. He knew all of that stuff. He understood portable alpha, and in fact, he was the guy that really enlightened me about derivatives and portable alpha and overlays. Right, so he took me to see Marv Damsmet at BP Amico. Mm-hmm. And for those of people that are listening to this, they're older, that might remember Marv. He was one of the pioneers of portable alpha way back in the day. Wow. Kodak, as a matter of fact, and Weyerhaeuser are two other firms that use portable alpha. Rusty Olson at Kodak and Weyerhaeuser as well, way before anybody even called it portable alpha. Like, they didn't have a name for it. It's just how they manage portfolios. Right. Mm-hmm. But anyway, Rick took me to meet Marv Dansman. In fact, Don Pierce, who I mentioned before, went with us on that trip to Chicago to BP Amico. And we sat down for a day and a half with those guys and learned how they ran portable alpha and kind of studied how they did it. We didn't implement the same way they did, but it wasn't too far off. But it's mentors like that, mentors like that change your life, right? They change the trajectory of your life and make you better. Another perfect example was my first boss at SB Sarah. His name's Terry Slattery, and phenomenal first boss, taught me a ton. And I remember him telling me, Tim, I want you to sit with everybody in the office and learn their job and make sure that you understand how to do it. And if there's any problems with how they're doing things, I want you to fix the process.
Wow.
Like, all right, I want to just do investments. And
this was your first job out of college.
And he's like, yeah, you will. Just go do this. Right. And like, there was no leeway whatsoever. And I was like, man, he doesn't understand. I need to do investment. Anyway, fast forward, I went around, learned everybody's job. I even helped rebuild people's spreadsheets to calculate purchases of time in the pension fund, things like that. Wow. And by the time I finished doing all that, I was a little slow at that time, but I realized what he had done, which is to teach me the pension system inside and out. At the time, I didn't recognize that, right? But when you're in the face of doing it, you just kind of want to do investments. But in hindsight, like, he did me a big favor, which led me to become eventually the executive director and the CIO of that firm. And I don't think I could have done that job without his mentoring and forcing me to learn the ins and outs of a pension system at that level, right?
Incredible.
And I'd say that, another person was Alan Martin. He was our consultant, my first consultant. And he just, a lot of the things that we talked about earlier, where you eventually slowly get autonomy and things, it was his guidance and his helping to train me how to speak to a board, how to do pacing. And, I was young. I wanted to get everything now, like all young people do. And Alan was really good about sitting me down as a young executive and saying, listen, he goes, we take things in time and space. Like, you have to do things in steps. You can't just go ask for all of it. And he really helped guide me and teach me, like, how do you work with the board? How do you communicate with them? And how do you take your time and lay out a game plan for them to get to your end goal? And that takes effort, and it takes skill. And he was phenomenal at that. And I probably wouldn't be as successful today without those people.
Incredible. So you learned the pacing of the breakdown for a board presentation.
Yeah, you have to, you not only the pacing of the breakdown of the board presentation, but the pacing of the presentations. So your first presentation is going to say, I want to do X. Your goal is to get all the way to Z, right? But you're only going to talk about X in this presentation, later Y, later Z. So you pace it out in segments so people don't get overwhelmed and see too much change at once.
Can you break that down for me with an example?
Yeah, I would break it down this way. So if you wanted to do portable alpha and you
Mhm.
wanted to tell your board about it, the very first thing you do is you show them, today I'm going to talk to you about what the absolute return I can get from active managers is. How much can they beat the market by on average? And
Mhm.
if I structure as portable alpha, a derivative with a hedge fund and cash, what will my excess return be and why will it be more consistent, right? So you sell them on that idea first, right?
Mhm.
If my goal all along was to implement portable alpha with a tactical overlay, I'm not going to talk about the tactical overlay out of the gate, right? I just want to introduce portable alpha and get people comfortable that, hey, we're going to use derivatives to get exposure and we're going to structure it this way. If I can get
Mhm.
the yes on that, let's wait a year, run it, show it we're successful. Even though I know I'm going to do tactical later, or at least I'm going to pitch it, I wait and I pace that out a year from now so that I have a year track record and I say, see, it works. Now we're going to take step two. But you don't talk about step two before step one's approved and before you have a track record in step one.
What
So
kind of track record? Yeah.
it's you have to beat the index with your portable alpha structure on a much more consistent basis than the active managers do, right? Some boards will want you to have sometimes you can push it. If you have a 1 year track record doing that internally, you might be able to add something onto that afterwards. Sometimes it might take you 2 or 3 years, right, to get the board comfortable. But once they're comfortable, then you take the next step. So the pacing is all about your long-term vision of where you want to take the plan and what are those steps and taking it slowly and getting approval each step of the way.
Fantastic. Thank you for letting me know.
My pleasure.
You built neural net frameworks for picking stocks when you were in grad school?
Yeah, I loved grad school. So undergrad, I got an undergrad. I really didn't know what I wanted to do. So like a lot of kids, I just went to grad school. So in grad school, I met these guys that were running a thing called the Aztec Equity Fund. This is at San Diego State University in San Diego. And these guys we raised money. So I worked with them and we raised money from investment managers, most of them in San Diego, as a challenge grant. Like if we would raise money from people we know, they would match it, right? So we ended up having about $250,000 portfolio, and we picked stocks. And there was advisors from the Graduate School of Business that sat as our advisory board. But we built the whole program. We'd be responsible for certain sectors. And the guy that founded the Aztec Equity Fund, Andrew Mark, who I think still works at Globeflex, him and I would on weekends go down and mess around with a neural network. He was the main architect on it, but we'd sit around and talk about that and say, what factors do we want in our neural net? So think of it as just looking at all the fundamental factors you can have of a corporation or a security, and then trying to program that in to run through all the data and look for the best stocks, right? So if you were targeting return on equity, which stock would be best, right? So you'd want to see improving margins, right? You'd want to see improving return on equity, all these different factors. And you just computerized it, basically. So yeah, while other people were going out, we spent our weekends doing that. So it was quite fun back in the day. Not near the pressure that investment managers have. Like ours was challenge grant money, and we were grad students, but really gave you insight into the industry.
Did it do well?
It did. It did pretty well. We beat the market index for the time I was there for the 2 years, but not by as much as we'd hoped. Right? I mean, we won, but barely.
Yeah, that was that
That
was
was
a heck
good.
of a lot of work. Yeah.
Yeah,
But it trained you up in factor investing.
I think it helped me understand financial statement analysis really, and what moves stock prices, right? So like there was a lot of focus on free cash flow, on earnings, et cetera, and disaggregating the drivers of earnings. So it really cemented that kind of CFA level type stuff that people think about when they analyze a company.
Makes sense. But you have a special place in your heart for college kids or recent grads, and you've had some really strong mentors yourself. Now you've built an internship program that offers great opportunities and the most promising candidates something of a future. Can you talk about that?
Yeah, We ran an internship program up until COVID, then kind of had to shut it down during COVID, and then reopened it again. And it did okay pre-COVID. After COVID, it's really ramped up. Like we've got the business school much more involved now, and the deans to where they promote it a little more. So all the kids hear about it at Texas Tech University. Texas Tech is a system, so we have Angelo State University, Midwestern State University, etc. So all these kids from these universities hear about our internship program and can apply. I would say pre-COVID, we'd have, I don't know, a handful of people apply. We had, I think, 60 interns apply for this last summer. So we've had a massive increase in like words out. We're super, super excited.
Wow.
We typically take in 3 interns, and they work all summer. We're going to expand that to operations side as well. So right now, this summer we did all investment. Next summer we're going to do investment and operations. So it may grow to like 5.
Hmm.
And we give them the full run of the gamut. They have to do presentations. We have them analyze a private equity manager and compare it to the private equity universes and categories, and do all the analysis and do a write-up and presentation for the whole investment team. We also do that with hedge funds as well. So we try to give them a little exposure to all the different asset classes while they're here. We also built a program where they go fly to Boston and meet NEPC, our consultant. And our consultant walks them through and kind of gives them what the view of the industry is and how it looks from the consultant's viewpoint, right? So who are their clients? How are their clients different? And then they walk them through the asset classes and research groups. So the kids really leave with a really good, broad understanding of the market and a detailed understanding of like, what does it mean to evaluate managers? And we critique them on it. And so far, the feedback from the kids has been fantastic. They love it. So we like this program so much that I went back to my CFO, who I report to, and said, I think we need to take it one step further. Internships are great. They get to put some on the resume, but they're still young kids. And when they get out of here, it's still tough to get in this industry. So what if we created a new position called investment associate, where I could offer an intern that graduates school a real job? And that job's for 3 years. It's contract only. Each year I'll reevaluate where you make the next year. And that way we can hire what was an intern, a fresh graduate, and give them 3 years of hardcore experience. Like he's here every single day, just like a regular employee, gets a salary, benefits, the whole 9 yards. So we hired our very first investment associate this year that was an intern of ours. He graduated with his MBA, and it's worked out fantastic. And so like he'll sit in a vertical that covers hedge funds right now for 1 year. Then the next year he's going to do everything credit, both public and private. And then the next year he'll do everything private equity and real assets. So by the time he leaves, he'll spend a full year analyzing all these things. And really should be able to get a job just about anywhere he wants on the allocator side.
Fantastic.
Yeah.
Wow.
So we should have 3, and we'll hire a new investment associate each year. So we're really excited about that.
Wonderful thing. Hope it catches on.
I think it is.
Would you be open to people calling up and asking your advice on these things, especially within our allocator community?
Yeah, we're happy to talk to anybody about our internship program. Here in Texas, like we've even gotten together with UTIMCO and TRS, where there's an outing for everybody's interns to get together and network. So I know that most of the places here downtown Austin, all the big shops have huge intern programs. But if you're somebody that's starting out and trying to build one, yeah, absolutely call us. We're happy to dig in with you.
Beautiful. Nice. Tim, what would you like your legacy to be? You're a Hall of Famer, or soon to be one.
I always worry about legacy because I feel like it's like the time when everybody thinks you should retire. Like now, if you're, when you start talking about your legacy.
Let's say 10 years from now.
I'm not quite ready yet. Legacy, I think I would want people to say, Tim was a really good investor, but importantly, a great boss. I think one of the things that I'm most proud of is how many guys have become, and gals have become CIOs who worked for me. And I think that's like at over 5 or 6 now. Um, and it's knowing that I worked with all these different people, like the team that I have here at Texas Tech. And for me, trying to mentor them and make them better, and then watching all of them succeed. I mean, Don Pierce and James Berry, great example. I think Don's probably exceeded me. He's that good. So I think that the legacy would be I was a great boss and mentor to other people, and also a good investor, right?
Beautiful. Thank you.
Pleasure.
This interview is so much fun. I want to thank you for your time. Tim Barrett, CIO and Vice Chancellor of Texas Tech University in Austin. Austin? Sorry.
Austin, yes.
Okay.
Thanks, Christine.
Thank you. Thanks for your time today and all of your wisdom. Appreciate it.
Pleasure.